Real estate moves in cycles, and if you understand it, you understand returns. It doesn't matter whether interest rates are rising, falling, or just drifting sideways. Property values still follow the same structural pattern. That's why the question is never, is the market good or bad right now? The real question is simple. Which phase of the cycle are we in? It has 4 phases: recovery, expansion, hypersupply, and recession. And each one has its own signals, its own risks, and its own opportunities. Let's start with recovery. This is the bottom. The hardest moment to identify, but the most profitable if you get it right. Occupancy is low. Leasing is slow. Developers stop launching. Rents are flat or even below inflation. But something important begins to happen. Early signs of stabilization quietly appear. This is when distressed assets change hands. It's when value-add strategies, repositioning, and smart capital improvements generate huge returns because pricing dislocation is the deepest. Think of Dubai in early 2021. Anyone who bought in that trough saw 30 to 70% appreciation within 2 years. Then we enter expansion. Demand strengthens, vacancy drops, rents move up, construction restarts, migration rises, and job creation accelerates. This is the phase where everything feels easy. The perfect moment to develop, to redevelop, to refinance, and to scale. Cash flows improve, absorption is strong, and debt becomes more favorable. This was Dubai from 2022 to 2024, one of the strongest expansion phases in its history. But every expansion eventually leads to hypersupply. And this is where many investors get caught. Developers build too much, or demand cools unexpectedly. Rents are still positive, but growth slows. Inventory rises faster than absorption. Cap rates start to expand. Operators begin offering incentives just to maintain occupancy. The challenge here is simple. Most investors confuse momentum with trend. They buy because the market looks active, without analyzing the pipeline risk. This phase rewards discipline. It's the time to sell selectively, de-risk, rebalance, or reposition early. And then comes recession. Oversupply meets weaker demand. Vacancy rises, rents decline. Liquidity tightens and lenders become cautious. Deal flow slows and forced sellers appear. But this is also the phase where the strongest long-term portfolios are built. Distressed assets, discounted institutional stock, and forced sales create generational opportunities. If you have liquidity, discipline, and long-term strategy, this is the highest IRR phase in the entire cycle. And that brings us to the one factor that matters in every phase: liquidity. Investors who manage their liquidity, leverage, and duration outperform everyone else. You build liquidity during expansions. You deploy liquidity during recessions. You manage debt maturities early, long before the cycle forces your hand. You optimize cash flow and treasury operations constantly. Look at Dubai in 2020 and 2021. The investors who kept liquidity dominated the recovery that followed. Now, what actually moves the cycle? Demographics. Migration and workforce expansion directly drive absorption. Interest rates. Higher rates reduce borrowing power and compress valuations. Lower rates accelerate cycles. The general economy. Employment, income, and confidence all determine demand readiness. Government policy. Visa reforms, tax incentives, supply controls, and infrastructure investment can speed up or soften an entire cycle. Dubai is a perfect example. Golden visa, corporate relocation, long-term residency, a low-tax regime. These are structural demand drivers that push the cycle upward. And finally, not all asset classes react the same way. Residential, especially multifamily, is the most resilient. People need housing in every cycle. Industrial and logistics often outperform because of e-commerce, trade, and supply chains. Retail is very sensitive to the economy and consumer confidence. Office is the most structurally disrupted segment, with hybrid work reshaping everything. Only premium, highly amenitized buildings win consistently. This is the real estate cycle. Understand the phase, Understand the risks and understand the opportunity, because timing the market perfectly is impossible, but positioning yourself correctly in the cycle, that's where real returns are made. If you want a data-driven breakdown of the strongest opportunities in today's market, or a private strategy built around your goals, reach out.